The housing market crash of 2008 was so monstrously destructive that it was deemed a once-in-a-lifetime event, a crazy black swan collapse that couldn't be stopped and couldn't be predicted either, at least that's what we were told. The truth is that it was predicted by Michael Burry, yes, but by many more as well, and the warning signs were all there to anyone who actually wanted to see the truth. Nonetheless, millions swallowed the propaganda fed to them and willingly agreed that this would never happen again, despite all those same warning signs screaming at us once again. The truth is that the housing market in the United States and in many other countries as well is on the brink of a collapse even greater and even worse than we saw in 2008, and the only thing on the media's mind is trying to ensure we keep our eyes and ears closed off. But in this video, I will explain exactly what is going on. I will show you the evidence that proves housing prices have already started to fall, and I'll explain exactly why this is inevitable and how there is no real way out. All this because the housing market has already collapsed, you just don't know it yet. Now firstly, why are things going so poorly? How did the biggest boom in housing prices ever lead to the biggest crash in housing prices? And the answer is ridiculously simple. People are not rich enough to afford housing at current prices, so demand is dropping off a cliff and prices are therefore falling alongside. Something most people don't understand about housing prices is they are incredibly closely intertwined with affordability and wealth, far more so than with any other market across the world. If you give 100 people a raise of an extra $1,000 a month, then maybe 10 of them will go out and buy a more expensive phone. 20 might go out and spend more on holidays or vacations. 30 might go out and spend more on their car, and 40 might even spend more at restaurants. But 90 of those people will spend more on their home, the place they live every day, and it makes perfect sense why. The average person will spend about 2/3 of their life in their home, so when you make more money, you spend more on the things that have the greatest impact. And when the average person buys a home, they try to spend as much as they possibly can. They don't pick the best option for a good price like we do with cars or phones. We go all out and stretch our budget because not only will we spend all of our time in that home, but we also see it as a sort of investment. After all, in 30 years' time, the house will be paid off and now you have a large asset to your name, so it is a no-brainer. But this also means that house prices are always as high as they can possibly be, and there's little to no room for them to grow unless people get richer or debt gets cheaper. So what happens when debt gets more expensive? What happens when interest rates no longer sit at 0% but 5% or even higher? Well, suddenly the people who could afford a $500K home before can now only afford a $300K home, and this happens at every single different budget. And then you combine that with the fact that people are poorer today than they were 2 years ago, and the effect is even more pronounced. And believe me, people really are poorer today than in the years prior. Inflation has been raging well above wage growth, meaning in real terms, people are poorer when it comes to the money going into their accounts every single month, and it's even worse when you look at true inflation numbers and not the doctored figures that we get out of the Federal Reserve and the US government. The simple fact is that back in February of 2020, the median monthly payments for housing in the United States was $1,250, and today, just 3 years later, that number has doubled up to $2,500. Now, are you really twice as rich as you were 3 years ago? Are your friends or family? Is your city, or is the average person? Because the answer, unfortunately, is no, you're not. And to make matters worse, it isn't even just residential demand for homes that's falling, as it isn't just normal people who aren't able to spend as much on homes these days. For years, we were told that institutions buying up our homes wasn't an issue and wouldn't cause prices to inflate, but the media which pushed this charade was plain and simply lying to you. And after they spent billions buying up homes, forcing prices higher and booking massive profits, they suddenly stopped. Across the board, they stopped buying homes, they stopped even trying to, and the demand they used to flood the market with dropped off a cliff, and that is also having a massive impact on prices too. Of course, we all know about BlackRock and Blackstone and the massive amounts of backlash they got for buying up homes and how they have been forced from this political pressure to stop their games, but this has even happened with so-called iBuying companies whose sole exclusive purpose is to buy homes. Now, iBuyers were the ugly duckling of the tech bubble just gone. They are essentially just flippers. They buy homes, they renovate them and sell them on for a profit, but they wanted some of that sweet venture capital funding, so they tried to force technology into this industry under the flawed idea that it would increase profitability and allow them to scale. In the end though, it was a total, utter, complete disaster, and these businesses were quite literally losing billions every year, buying up homes to try and sell them later on because it was simply too difficult to manage 10,000 contractors on the ground working on 10,000 different homes all at once, and the algorithms for buying and selling the homes were nowhere near as efficient enough to get the prices right, so the iBuyers stopped buying homes. It started with Zillow, who almost 2 years ago now abandoned the practice, but before long, all their competitors followed, and now the hundreds of thousands of homes that were being bought by these firms are now just sitting on the market, forcing home prices down. The truth is that this housing market crash has been staring us in the face for a long time, and to everyone paying attention, it has been blindingly obvious for that time too. And we may have seen the last of 2022's volatility, but 2023 could give way to an equally frustrating period of stagnancy. Core inflation is still high, and we've now seen 10 Federal Reserve rate hikes making debt more expensive. Home and commercial real estate sales are likely to fall even further, and Charlie Munger has come out and said that when it comes to the US, a lot of real estate isn't so good anymore. But even today, there may be opportunities to dodge volatility and maybe even grow your wealth. Over the last year, financial advisors have been shifting their allocations altogether, leaving the 60-40 portfolio and opting for alternative assets instead. And Masterworks is giving you access to one of history's most exclusive investments in fine art. Since 2009, billionaire wealth increased by 380%, and in that time, the amount of art auctioned for over $10 million increased by almost 700%. There's no reason the ultra-wealthy should be the only ones to reap the benefits, and Masterworks allow almost anyone to invest in shares of art from legends like Picasso and Banksy, meaning you pay a fraction of its total value, and so far, each of Masterworks' sales has delivered positive returns to investors, which in today's economy should explain why over 700,000 people have signed up so far, including thousands of Stoic Finance subscribers. Demand is rapidly growing, but my subscribers can skip the waitlist by clicking the link down below in the description. Now, the evidence is showing one thing with absolute certainty, that the days of rising house prices are over and the days of another housing market crash are upon us. And finally, the mainstream media can bide their tongue no longer, lest they reveal themselves to be nothing more than puppets of their corporate masters, but they're still doing everything they can to gaslight you into thinking things are better than they are. This article from Forbes claims to be the voice of reason, with a relatively tame headline of "When will home prices be affordable again?" while simultaneously claiming that prices are falling, but only slowly, and so there's clearly nothing to worry about. And I'd like to keep that statement on hand, because prices are not falling slowly at all, they're falling even more dramatically than we saw during the crash that started in 2006. According to Redfin, home prices have fallen from $433,000 to $400,000 over the last year, a decline of almost 8%, which is a very rapid turnaround for a market as illiquid as real estate. According to Zillow, their data says that prices have fallen from $338,000 down to $334,000, a drop of just over 1%, but this is coming from the company that lost over $2 billion buying homes, renovating them and selling them on for less than they originally paid. So of course, some skepticism is required when it comes to their data, but even this dumpster fire of a business thinks that home prices are actually falling. The National Association of Realtors has leagues of data, and they claim that the market is slowing down considerably, with existing home sales falling by 2.4% over the last month alone, and they have pending home sales falling by 5.2% over the last month, and with the median priced existing single-family home values falling from a peak of $420,000 all the way down to $367,000, a monstrous decline of over 12%. And this data is coming from an industry that works on commission, so you best believe they know when home prices are falling or rising, because their livelihoods and their incomes quite literally depend on prices. And these are not small declines in prices, and to make matters worse, not only does every single private institution agree that home prices are falling, but even the US government says they're falling, with the Case-Shiller Index being a favorite indicator of housing prices across America, and it shows prices down from 308 on the index to 293, a decline of 5% over the course of just 8 months. Now remember when Forbes claimed that prices may be falling but it's a slow decline and nothing to worry about? Well, by their standards, the housing market crash we suffered under almost 2 decades ago must have been no more than a correction, because the first 8 months of declining house prices in the US in 2006 saw figures fall from 184 at its peak to just 182, a fall of only 1%. We have just seen this crash kick off with a 5% decline in 8 months, and the first 8 months of declines in 2006 were only 1%, so how anyone can claim this isn't a massive decrease is quite literally inconceivable to me, because the previous crash devastated the entire world, and this crash is already happening 5 times faster. And all of this makes sense if you just think about what is really going on. Interest rates have risen from 0% to 5% over the course of 1 year, and mortgage rates have risen to that same extent. A couple of years ago, an average person was able to get a mortgage of 2.5% on their property, which meant that if you earned $100,000 a year, frankly, you could afford a $500,000 house, as monthly payments were only $1,700. But if you were to try and buy that same house today, you'd be looking at interest rates of almost 7%, meaning the monthly repayments are almost twice as high at $3,000. The simple, unavoidable truth is that there are not enough people who can afford to buy homes at their current prices with interest rates so high. Something has to give, something has to change. At these levels of home prices, demand is nearly non-existent, so prices will naturally fall until there is enough demand to sustain those levels, and at this rate, prices are going to fall a lot for a number of reasons. Because at the end of the day, we've only really covered 2 of the problems the housing market is currently facing: the fact that inflation has reduced the wealth and purchasing power of millions of Americans, and the fact that interest rates have increased dramatically, meaning debt is more expensive than we've seen in literal decades. But there are so many more problems on the horizon which promise to make matters even worse, like the fact that student loan repayments have been halted for almost 3 years at this point. For 3 years, ever since COVID kicked off, student loans haven't been accruing interest, and they haven't needed repaying either. For 3 years, millions of Americans have just been ignoring them, pretending they don't exist, pretending they aren't a problem, and they'll never need to be paid back. But that just isn't the case. In fact, time is almost up, and repayments are going to have to be made within a matter of months. Now, maybe this isn't a big deal, I hear you say. Maybe student loans are an overblown issue and they aren't going to impact the economy at all. But unfortunately, that is just pure wishful thinking. As of 2022, there were 43.5 million Americans with federal student loan debt, and a year on from that point, we can be damn sure that number is even higher today. And back in 2020, when this debt was being repaid, the average monthly repayment was $400, back when interest rates were 5 times lower than they are today. So again, we can assume that they will be even higher than that. But let's just be generous for a moment and assume that $400 is where the monthly payments will remain for these 44 million Americans. Can they afford that debt? And can they afford another $400 a month going out of their pocket? Well, according to the most recent data from January of this year, 60% of adults in America live paycheck to paycheck, meaning they don't save anything, they don't invest anything, and they simply spend everything they have. 60% of adults, that is, meaning of the 260 million American adults, 156 million of them have no extra cash at all, and 45 million of them are about to have to cough up an extra $400 a month. To think that these people are then going to be in a position to go out and buy a house with interest rates near 7% is frankly ludicrous. These people are going to be lucky not to go bankrupt, let alone invest into their future, and this is all without even mentioning the brewing recession that is absolutely coming. The Fed may be claiming that there might not be any more rate hikes, but this is the same Fed that said money printing wouldn't cause inflation, that then there was no inflation at all, then it was just temporary and transitory, and even eventually that inflation was good for us, before they finally admitted fault after 2 years of total abject failure. How are we supposed to believe them when they say inflation is over now, when core inflation data has stopped declining and is sitting happily at 5%, annualized figures with no evidence that it's dropping any further? The simple fact is that the housing market is a people's market. It's driven by household finances, and people cannot afford to buy houses, so they won't buy houses, so prices will fall. It is the most basic of economics, and there is no easy way out. The chickens have come home to roost. It's game over, and we are on the brink of another great housing market collapse, only this time there won't be any quantitative easing to save us, as that will only spike inflation and make this whole situation even worse. Now, if you're interested in protecting your wealth from this crisis, then check out this video's sponsor Masterworks. Or if you just want to see how BlackRock fit into all of this, then watch this video here.